Today I'm going to show you exactly how I've been investing on a year-by-year basis from 2017 all the way up to now in the end of 2024. My journey has been far from perfect. In fact, it was quite messy at times, especially the first half of it. I tried out a ton of different investments throughout the last 8 years, some of which even lost me a good chunk of money. But that's life, everyone makes mistakes. The important thing is that my wife and I ended up being right on the vast majority of where our investment portfolio was allocated over the years. As a result, we're now closer to our early retirement goals than we could have ever imagined 8 years into our journey. In this video, you'll see how our investment style evolved over time and what we experienced as investors. Let's start things off with when our journey started in 2017. In January 2017, as my knowledge as an investor was still very limited, I started investing in the stock market via a robo-advisor, Scalable Capital. The reasoning made sense. I wanted to make my new life as an investor as simple as possible, without ever needing to rebalance or think of anything myself. The robo-advisor would take care of everything and pick the right ETFs for me. Just 2 months later, after reading a handful of books and doing a ton of research into the world of passive index fund investing, I realized I could just buy ETFs myself. I would be saving myself 0.75% in yearly management fees, which the Scalable robo-advisor was charging on top of each ETF's internal total expense ratio. Another bonus was that I would have full control over how my money was invested, as I didn't like how it was being allocated at the time. Now that it was all up to me, I did what so many people do when they first get into the world of ETFs. I got a bit too excited and overcomplicated my portfolio by buying a total of 6 ETFs. At the time, I was convinced that I could beat a single global ETF by selecting an ETF for every region and sector I wanted to cover, with a precise percentage allocated to each one. 20% in the S&P 500 for US stocks, 20% in the Stocks Europe 600 for European stocks, 15% in the MSCI Pacific, which I think you can't even find ETFs for anymore, 10% in the MSCI Emerging Markets, and for extra exposure to smaller companies, I allocated 10% each to USA Small Cap and Europe Small Cap ETFs. The plan was to rebalance on a regular basis and to hopefully outperform a simple world ETF that way. But in practice, this added complexity and costs. I hadn't factored in things like taxes whenever selling a position that's in profit for rebalancing, for example, or the amount of work that would be involved, as well as trading fees. Which is why I ended up selling 5 of the 6 ETFs I was holding in September of that year and switched to a simpler 2 ETF strategy. 75% MSCI World, 25% MSCI Emerging Markets. This is when my wife started investing in ETFs as well, using the same strategy. This reminds me you can find the best local brokers for ETFs linked down below, which is a great way to support me if you'd like to. 2017 was also the year I first got into the emotional roller coaster better known as crypto by buying Bitcoin and Ethereum. Blinded by both of these shooting up in price, and my limited experience as an investor at the time, I ended up making an extremely risky decision. I invested a total of 20,100 euros, a large share of my overall investment portfolio, into these highly speculative digital assets that year. Let's see what happened next in 2018. Well, the year started with me feeling like a genius as my high-risk investment tripled in value, and ended in major disappointment after an 88% drop, with my speculative investments suddenly being deep in the red. Filled with regret for not selling any of it earlier, I left my crypto untouched for the next 2 years. Meanwhile, my wife and I kept adding money to our ETF portfolio and decided to simplify it even further at the end of 2018 by only buying a single ETF, the Vanguard FTSE All World, covering both developed and emerging markets on a market cap basis. We held on to our existing MSCI World ETF shares though, since these were nicely in profit, and there's no point in selling them and having to fully tax these already now instead of later on in retirement when we actually need the money. That same year, I also started investing on a handful of peer-to-peer lending platforms due to the high interest rates they were offering, combined with a false sense of security since they advertised a buyback guarantee for non-performing loans. Which brings me to 2019 to 2020, which wasn't an easy period either. In early 2019, my wife and I made a major mistake. It was the only time where we blindly trusted the experience of a friend who had managed to double his money via automated forex trading without fully understanding any of it ourselves. The strategy had great returns at the start, which we felt encouraged by. But then things turned south and we ended up losing a total of 10,000 euros. That was a painful lesson and we never touched anything like it again. To make things worse, in 2020 a few unregulated peer-to-peer lending platforms closed down and stopped withdrawals, citing COVID as an excuse. I was shocked to have lost access to around 6,600 euros so abruptly and felt horrible for ever mentioning any of them on my channel. All of a sudden I realized that peer-to-peer lending came with an entirely different set of risks I hadn't even considered before. Luckily, most of our savings were going into our one ETF investing strategy throughout this difficult period, and our returns of 31.7% in 2019 and 5.3% in 2020 made up for our setbacks. Not only that, by the end of 2020, Bitcoin had more than recovered and my crypto holdings were back to their all-time highs at around 60,000 euros. I wasn't going to make the same mistake twice, so I finally took out my initial 20,100 euro investment, which I moved into our ETF. I decided to leave the remaining 2/3 invested, but now I was going to be a lot more relaxed about whatever the outcome would be. Then came 2021 to 2022 and our investment strategy became even easier. At the start of 2021, we switched to the accumulating version of the Vanguard FTSE All-World due to it being a bit more tax efficient and easier to manage long term compared to the distributing version, where we would need to reinvest the quarterly dividends manually ourselves. More than 90% of our monthly savings were going into this single ETF during this period of time. Once again, we held on to our distributing ETF shares since these were nicely in profit and we wanted to avoid unnecessary taxes. At the same time, Bitcoin and Ethereum continued their rally and I realized further profits in 2021, which I also moved over to our ETF to avoid being overexposed. My plan was to keep my allocation to this high-risk sector at around 10% long term. And after seeing it crash again in 2022, that turned out to be a good call. Meanwhile, I became less and less interested in peer-to-peer lending and its proportional share in our overall portfolio decreased further. Which brings me to 2023 and 2024, which is about to end. As the ECB raised its rates due to high inflation in Europe, we were finally able to earn an attractive interest rate on our euro cash reserves without taking on investment risks. Since the German bank and broker Trade Republic is passing on the ECB rate 1-to-1 to its users, and our money is secured by a 100,000 euro bank deposit guarantee, we've been using it as a high-yield savings account ever since, earning a total of 972 euros in interest so far on money that would otherwise have been earning zero on our Austrian bank accounts. Two more notable things happened in this period. First, we decided it was finally time to exit peer-to-peer lending completely in mid-2024 and to simplify our investment portfolio even further. 90% low-cost ETFs and 10% Bitcoin. That's it. And second, since we're speaking of low-cost ETFs and Vanguard's fees had now become comparatively high at 0.22%, as the asset manager has now left them unchanged for over 5 years, a complete contradiction of what the company is supposed to stand for, it was finally time to consider another ETF accomplishing the same with lower fees. So for about 5 months now, we've been investing our monthly savings in Invesco's accumulating FTSE All-World instead due to its lower total expense ratio of 0.15% per year, as well as a better tracking difference since its launch. Alright, let's do a quick recap of how our investing strategy evolved over time and where we are today. We started with up to 6 regional ETFs, and now we only buy a single accumulating all-world ETF, with ETFs making up around 90% of our portfolio. As for peer-to-peer lending, it at one point had a share of up to 25% of our portfolio, but now its share is closer to 0% as we've decided to cash out. Meanwhile, we were way overexposed to crypto at one point as I got fully caught up in the hype in 2017, while we're now aiming for a long-term share of around 10% in our portfolio with a focus on just Bitcoin. As for our cash reserves and emergency fund, they were earning 0 on our Austrian banks before, and we're currently earning the ECB rate, which is 3.25% using Trade Republic. By the way, I'm expecting the ECB rate to drop further over the coming months and years, but we'll gladly collect the interest as long as it's there. And lastly, other investments like Forex trading in 2019, never again we learned our lesson. And there you have it. You now know exactly what we've gone through over the past 8 years as investors and how our strategy evolved over time. As you can see, the first few years were particularly rough, with my wife and I making plenty of mistakes and not managing risk properly in the beginning. But the important thing is that we learned from them over time and ended up being right on where we invested the vast majority of our money on an ongoing basis since 2017, our long-term investments in ETFs, which have grown significantly since we started, and even personal high-risk bets of mine like Bitcoin ultimately gave our portfolio an additional boost in returns over the years. It's definitely not for everyone though, and in my opinion, most people should just stick with a simple global ETF in the long run. While we're getting pretty close to our early retirement goals as it stands, I hope that I was able to show you that our journey has been far from perfect with today's video. So give yourself a break if you've also lost money at times. Just try to learn from your experience and avoid repeating mistakes. But now I want to hear from you guys. How did your investing strategy evolve over the years? Are you surprised by what I shared today? Let me know in the comments below. Before I take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to the best low-cost brokers in Europe for ETFs, as well as other financial tools I use. Also, please don't forget that none of what I shared today was of course meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.